Collapse and comeback. On the morning of the 9th of March 2023, customers of one American bank tried to take out $42 billion. Not over a month, not over a week, in a single day by phone and by app. By the following afternoon, the bank was closed, its doors locked by state regulators. It had existed for 40 years. Here is what makes this story strange. There was no fraud, no rogue trader, no hidden loan book stuffed with bad mortgages. Silicon Valley Bank died holding some of the safest assets on earth, United States government bonds. This is the story of how safe became fatal, and how fast money moves when it is only a number on a screen. Silicon Valley Bank opened in 1983 in Santa Clara, California, reportedly conceived over a poker game. Its bet was simple. Ordinary banks did not understand startups. A company with no profits, no assets, and a good idea could not get a business account, let alone a loan. Silicon Valley Bank would be the bank that said yes. For 4 decades, that bet paid. It banked the founders, the venture funds that backed them, and the winemakers of Napa on the side. By 2022, the bank said it served roughly half of all American venture-backed technology and life science companies. If you raised money in Silicon Valley, this is where the money landed. Then came the pandemic boom. Interest rates fell to near zero, venture funding exploded, and every one of those startups parked its fresh capital at the same bank. Deposits went from about $62 billion at the end of 2019 to roughly $189 billion by the end of 2021. The bank tripled in 2 years. That sounds like triumph. It was actually a problem. A deposit is not the bank's money. It is a debt the bank owes you on demand. To earn a profit, the bank has to lend it out, but its customers were flush with cash. Nobody needed loans. So tens of billions of dollars sat there, earning almost nothing. So the bank did what the textbook says. It bought bonds, mostly U.S. Treasuries and government-backed mortgage securities. It classified a large share as held to maturity, an accounting choice that means, we intend to keep these until they pay out, so we will not mark them to the daily market price. By the end of 2022, that pile was about $91 billion. Now the part that killed them in plain language. A bond is a fixed promise. This paper pays 1.5% a year for 10 years. If new bonds start paying 5%, nobody wants your 1.5% paper at full price. Your bond is still safe. It is simply worth less today. And in 2022, that is exactly what happened. Fighting the fastest inflation in 40 years, the Federal Reserve raised its target rate from near zero in March 2022 to 4.75% by February 2023. It was the steepest tightening cycle in decades. Every long bond bought in the cheap years quietly lost value. By the 31st of December 2022, the bank's held-to-maturity portfolio had a book value of about $91.3 billion and a market value of about $76.2 billion. The gap, roughly $15 billion, was larger than the bank's entire common equity. On paper, the bank was already gone. On paper only, though, because held-to-maturity accounting meant that loss never touched reported earnings. It sat in a footnote in the annual report, visible to anyone who read that far. Very few did. The bank was, in the words of its regulator's own later review, unusually exposed to interest rates and unusually slow to manage it. Then the second leg gave way. When rates rise, venture funding dries up. Startups stopped raising and started burning through the cash they already had. Deposits, which the bank had assumed were sticky, began draining away, falling from about $189 billion to $173 billion across 2022, and still going. To pay departing customers, the bank needed cash it did not have lying around. Its money was locked in bonds worth less than it paid for them. Management decided to take the pain in one clean move. Sell part of the portfolio, absorb the loss, raise fresh capital, and reset the balance sheet for a higher-rate world. On the 8th of March 2023, it announced the plan. It had sold about $21 billion of securities at an after-tax loss of roughly $1.8 billion, and it intended to raise about $2.25 billion of new capital. In a calm market, that is a competent, boring repair job. The market was not calm. The same evening, Silvergate, a smaller bank serving crypto companies, announced it was winding down. Investors read the two announcements together and reached one conclusion. A bank does not sell its bonds at a loss and ask for capital on the same afternoon unless it needs the money now. And here is the modern twist. Silicon Valley Bank's depositors were not a scattered public. They were a tight, wealthy, hyper-connected network. A few hundred venture funds who all knew each other and all sat in the same group chats. Reporting from that week describes several prominent funds telling their portfolio companies to move their money out immediately. The advice traveled faster than the bank could answer the phone. On the 9th of March, customers ordered $42 billion out of their accounts in one business day. That is roughly a quarter of everything the bank held. The parent company's shares fell about 60% that day. There was no queue on the pavement. There was a login screen. This is what made it the fastest bank run on record. The classic run is limited by physics. How many people can stand in a lobby, how fast a teller can count. A wire transfer has no physics. One person, one laptop, 10 seconds, and $100 million is somewhere else. The next morning, the 10th of March, the state regulator later reported that customers had queued up roughly $100 billion more in withdrawal requests, money the bank plainly could not produce. Before the trading day was out, California's Department of Financial Protection and Innovation closed the bank and handed it to the Federal Deposit Insurance Corporation. Then the second panic began. Federal Deposit Insurance covers $250,000 per depositor. But this was a bank for companies, and a company account holds payroll. Around 94% of the bank's domestic deposits sat above the insured limit. Thousands of startups faced a Monday with no way to pay staff. The weekend that followed was one of the tensest in recent American banking. On Sunday, the 12th of March, the Treasury, the Federal Reserve, and the FDIC jointly invoked a systemic risk exception and announced that every depositor at Silicon Valley Bank would be made whole, insured or not. Shareholders and bondholders would not be. At the same time, the Federal Reserve opened a new emergency facility, the Bank Term Funding Program. It let banks borrow against their bonds valued at face value rather than market price, effectively removing, for everyone else, the exact trap that had just caught Silicon Valley Bank. It half worked. Signature Bank was closed the same Sunday. Credit Suisse, wobbling for years, was pushed into the arms of UBS inside a fortnight. And in May, First Republic Bank failed and was sold to J.P. Morgan Chase. Measured by assets, 3 of the 4 largest bank failures in American history happened inside 8 weeks. The cost did not fall on taxpayers directly. The FDIC Deposit Insurance Fund covered the uninsured depositors, and the FDIC then recovered that money through a special assessment charged mainly to large banks. The people who lost outright were the shareholders and bondholders of the parent company, whose stock went to zero. The pieces were sold quickly. On the 27th of March, First Citizens Bank shares bought most of the bank from the FDIC. The parent, SVB Financial Group, had already filed for Chapter 11 bankruptcy on the 17th. In April, the Federal Reserve published its own review, and its verdict on its supervision of the bank was unusually blunt. Too slow, too gentle, too late. 40 years to build, 36 hours to unwind. Silicon Valley Bank did not fail because it gambled. It failed because it treated deposits as if they were permanent and bonds as if they were cash, and because in 2023 a bank run is no longer a crowd at a door. It is a group chat. If you enjoyed this story, subscribe. New collapses and comebacks land 3 times a week.